Thank you very much for joining me. I'm going to give an update and outlook for the year ahead. Moving straight into the presentation, just a quick update on Centaur. Centaur's three founding principles remain unchanged: to deliver investment excellence with outstanding service and utmost integrity. These are really critical to the ethos of the business, and we believe if we can deliver on these, we're going to deliver an exceptional product to our clients and meet their needs and have very happy customers. At the end of last year, we had 6.6 billion of assets under management. And note that we're a retail-only asset manager. We don't have institutional clients. And that's why possibly our assets under management are a little bit smaller than our peers. We had strong net inflows in 2022, around 6% net flow of funds, which we're very happy with and shows the strength of the business. We've got a tightly knit team with bonus pools to remunerate staff, and also select members get profit share. There was a staff change. Jacques Haasbroek left Centaur in November last year. Just to look how the business is structured, 9 team members at this stage. On the left is Kirsty Dale. She heads up operations and client services, and she's assisted by Megan Morris and Kelly Sue Africa. And a very, very capable team. The operation runs very, very smoothly, and very important that things run smoothly and enable me to really manage the assets. Chris is also an invaluable member of the team. He's been with us 4 years. He does its marketing, but also importantly, presentations, also IT, and also quarterly reports. So a very integral member of the team. On the investment side, besides myself, I do both portfolio management and research. I remain very hands-on. I think it's very important for a portfolio manager to remain hands-on. But then further analysts and portfolio managers are Nicholas de Vos, Lang Walker, and PJ Prinsloo. So a very capable team with a diversity of skills. And both Nick has been with us 3 years and Lang 5 years. So a good tenure at Centaur. Mick is also an invaluable member of the team. He is a trade and quants analyst, and he really is low-key but very intrinsic to the business, making the operations of the asset management run seamlessly. So if we need to do a trade, we can do it at a moment's notice. We're currently satisfied with the team, but we're actually looking to recruit to facilitate expansion and just give a little bit more flexibility too. We're particularly proud of our long-term track record. So since inception, this is on a net basis after fees. Centaur's been operating over 22 years. The combined net equity strategy has delivered 18.4%. Outperforming the benchmark by 7% per annum, and this is after fees. So our earliest clients are up over 40 times, and we're looking to continue a very proud track record. Our investment philosophy, we classify as dynamic value creation, and this is really, we're looking to buy growing undervalued companies. So on the left, to contextualize what this means, is we're looking for a company to at least earn its cost of capital. That's 14%. So over 3 years, the value of 100 would grow to 148%. That's a 14% annual return. If we can buy this company at a discount to fair value, let's say at a 25% discount in year 0, and it moves to fair value over 3 years, that growth of 14% gets arbitraged to a 25% return. So this is conceptually what we're trying to do, look for opportunities that fit this mold. And then we've really boiled this down to repeatable themes which give rise to opportunities. And then we've built systematic models to really exploit these opportunities. I think what's very important, you need a balance between really judgment and process. If you get too process, it slows you down and you miss opportunities. You get too rigid. If it's too laissez-faire, then the risks increase. So what we're trying to do is create the optimal balance between process, flow, and judgment, that we can act quickly. We can use our judgment, but also that there are controls within the process to ensure that your money is safe. The flexible fund, the performance since inception, 15% versus a benchmark of 11.6. That's an outperformance of almost 4%. That's on a net basis. 10 years still strong, very strong performance. 1 year a bit disappointing. I'll unpack that a little bit later. There were a couple of shares which under-delivered, particularly offshore. But over 3 years, the net return is 10.6, outperforming the benchmark. 5 years, similarly, a net return of 8%, outperforming the benchmark by 6.3%. The balanced fund is a similar story, a disappointing year last year, but over 3 years, 5 years, and since inception, the numbers look much better, very much in line with quite a difficult benchmark to beat. So some of the top contributors and detractors in the fund last year. So Thungela, we bought a relatively small holding, but it virtually tripled. So that contributed an outside amount of about almost 2% to the fund. Then others were Absa. We had a large position that returned 35%. Outsurance really did exceptionally well, up 49%. That's a 1% contribution. On the flip side, you can see some very big detractors. I think the ones to note are Aspen, PPC, and Entain. These were 3 of our best performers in 2021, and they reversed in 22, giving a negative contribution. And part of the reason for the disappointing performance last year was really a reversal of these shares. So if you look over 2 years, our performance is not too bad, but at the end of 2021, because these shares performed so well, created a very high base, which reversed last year. The other one to note is Spurbank. That, I think all the metrics look very solid. Russia as a, financial metrics looked solid, but this share got suspended, and that was down 49%, and also a big detractor. And that's part of the reason for the underperformance last year. So looking at attribution over a 3-year basis, Centaur has been outperforming its benchmark in 2020, 2021 on a gross basis, and also on a net basis. So you can see in 2021, we outperformed on a net basis by almost 5%. 2022, that reversed. And really, the weakness there was the offshore equity, down 26%. Particularly note was really Spurbank, which dropped 50%, and excluding that, the offshore equity would have delivered about minus 20%, slightly below benchmark. We're also overweight offshore. Part of the reason is because of the exceptional performance in both 2020 and 2021. It grew to an overweight position. We did pair that in late 2021, but not enough. So that portion of the portfolio really contributed to the negative, to the underperformance. And we have re-looked at that and made our desired changes. Local equity, last year we delivered at 5.9%. That outperformed the benchmark, and fixed income at 5.3 also outperformed the benchmark. So that's really the reasons. Looking over a 3-year basis, our gross performance is 12.5%. The benchmark's delivered 10.2. So we've delivered a 2.3% outperformance before fees. After fees and adjustments, the fund is outperformed by 0.4%. So on a 3-year basis, still indicating the ability to generate alpha. So actions undertaken. There are certain learnings we have undertaken. If our performance is below benchmark, we don't say, listen, it's just the market. We also look if there are any actions we can do to improve it. I think the most important is really the South African game has changed materially. Our top 5 shares, excluding British American Tobacco, are very China focused. I don't think we have given China enough focus and maybe a little bit of benchmark risk there. So more focus. We've always looked at them, but greater focus on Richmond, Naspers, Anglos, and Billiton. We got hurt by Spurbank, which got suspended, and now it's back in the portfolio, but was down 50%. I think we have to be wary of really frontier market trades. I think we have to be more on point on execution and selling disciplines, and this really speaks to late 2021, where we had some exceptional performers, notably PPC, Entain, and Aspen. We did sell, but we didn't sell enough. So if we had sold a greater proportion in the latter half of 2021 and been more aggressive, we would have locked in some of the gains, and we've really took some learnings from that. We're also underweight equities in the second half. I think this was a purposeful strategy. What we were saying is this cycle is different. We think this could be a more of an extended bear market. We can speak to it later. We just have to be careful that we're not too underweight relative to benchmark, because if we're wrong in our view, we don't want to be out of the race. We want to still be in sight of the front runners and be able to catch them up. So we're just going to take a more scaled underweight position, and that really speaks to our investment strategy. I think we're maintaining our conviction in our stock picking and processes. If you look over 3 years, we have outperformed our benchmarks in our stocks, and also so it's not that is not broken. We're also tweaking fixed interest to squeeze incremental returns. We're making sure there's no cash drag. We're taking a little bit of liquidity risk on NCDs, which is a minor risk, and we think we can squeeze about an extra 0.5% there. This is more important at the margin. I think we assessed the portfolio and executed our desired changes. For example, overseas, we had a holding in Entain. We decided Flutter is a far better investment in the same industry. We had a holding in Life Healthcare, hadn't delivered relative to expectations. We've made a reasonable profit. We've sold that. There's also other changes which I'm not mentioning at this stage. Just going really into portfolio strategy, I think energy prices have been an area of focus. So, looking over the last 3 years, really the base is 100. You can see gas in Europe. We're using the Dutch natural gas price as the benchmark. It's up 5.7 times over the last 3 years. But having said that, over the last year, it's actually marginally down. So Europe has adjusted to the higher gas prices to some extent, and it looks like that energy crisis is really over in Europe. They've actually, the gas usage has been much lower than anticipated. So this is a positive development. You can see the black line, coal up 2.6 times, and US natural gas up 2 times. So these energy prices have had a shock, and really part of the reason we saw that volatility in the first half of the year, but it is abating to some extent and being adjusted into economies. Oil's been relatively weak. So it was over 120 in the early half of last year. I think oil is particularly important because it feeds inflation throughout the world, and really is like a fulcrum. If it gets too high, it's negative for markets. If it goes down, it's positive. I think this current weakness around $80 to $85 is going to be transient. China is going to come back into the markets after they're opening up. They're a very big consumer. I just read a report in the Financial Times today. They expect record oil demand. So I think oil will go closer to 100 towards the latter half of this year. And as the economies start picking up pace, I think there's a fundamental shortage of oil worldwide, and it can go more towards 150 in the medium term. So this is a place we've actually invested. We think that there's very positive payoffs in oil stocks, and we've increased our holdings there. Looking at interest rates in the US, particularly important. If we look at the last 5 hiking cycles, this is the most aggressive hiking cycle actually in history. So in 2022, in under a year, interest rates have gone up 4.25%. What history teaches us, after aggressive hiking cycles, the risks on the downside. It may not happen immediately. Everything looks okay, but possibly 18 months down the line, there's often some major kind of downturn in markets, and the risks are much more elevated. I think people are ignoring this interest rate cycle. There seems to be a positivity around. I think we just need to be aware of these contingent risks. So we are underweight equities. I think it just hasn't played out yet, and as we move late in the year and maybe next year, there are downside risks. So one must be very wary of this aggressive rate hiking cycle. Having said that, US interest rates are 4.5%. The most recent core inflation was 5.7%. So interest rates are still negative in the USA. So people are kind of saying, listen, the cycle's over, but interest rates still haven't normalized, and people are looking for much lower inflation. We are a bit wary on inflation. We'll give the reasons why. So the 5-year break-even inflation in the US has moved down to 2.5%. This is what the market expects. I'm not sure. I would expect it to be higher than this, and we don't think inflation has been knocked out for the following reasons. So, core inflation, which excludes food and energy, was around 6% of the last year. So you can see a massive elevation from its long-term trend of between 1% and 3%. It was there for almost 30 years. Now it's kicked up towards 6%. I think what's particularly important, despite the interest rate hikes, unemployment is still near record lows of 3.5%. So US labor markets remain very tight. And really, employees do have strong negotiating power, and wages are going up strongly. There are also tight commodities. So we've seen as soon as the news of China comes back in, as soon as news of it opening comes in, things like copper move up immediately, iron ore move up immediately. And I think this really talks to lack of new supply coming on stream. And if the economies start growing strongly, I think we can see oil back up to close to more to $150. And really this is going to feed through to inflation. Also things like lithium in very tight supply, copper in tight supply. So this downturn of a high base in inflation, we think could be transient. There's really related to the environmental theme, there's been underinvestment in many assets such as oil, coal, refinery, and mines. So we actually think inflation could be more in the range 3 to 6%, which is much higher than the past. Also, the risks are to the upside in inflation more than the downside. I think comparing this US downturn to previous downturns, you can see it can take an extended period to play out. So starting at the end of 2021, the black line is the current bear market in the USA. You can see it's only been running a year. The downturn in 2000 to 2003 took 3 years to play out, and the downturn in the early 1970s took almost 2 years to play out. So there could be a lot further Weakness in markets, particularly with high interest rates. I think we just have to be wary, and this really speaks to an underweight position in South Africa, in equities generally. Looking at long-term P ratios of the S&P, currently it's still about 28 times, which is very high. With the highest interest rates, there has been a change. So the US market is not cheap and still actually looks quite expensive. Turning more to South Africa, maize prices, they've come off their peak. So that's the green line. The peak was about 5,500. They're closer to 4,500 at the moment. But over 12 months, still up 30% year on year. So still feeding into food inflation. But the recent downturn is positive, and we could see food inflation peaking later this year. Wheat prices were up 10% year on year, and those have really come down quite substantially from the first half of last year. So that is a positive indicator for SA food inflation. The Rand purchasing power parity, we've followed this model for about 10 years. It's been a good indicator of the fundamental value of the Rand. The Rand is quite undervalued. So according to this model, a fair value is 13.3. The Rand's currently about close to 17. I think we are cautious on this because of the very high producer inflation in the USA, it kind of reduced the effectiveness of this measure. But nonetheless, the Rand is undervalued relative to history. I think South Africa, you read the newspapers or Twitter, and there's a lot of negative things, but the news is not all that bad. So I think most importantly, electricity supply is our biggest headwind, but businesses have been very resilient. And I think what's changed is, let's say 15 years ago, there was a little alternative for Eskom. Now with inverters, renewable energy, there really are quite strong alternatives, and a lot of members of the community have got inverters, and really load shedding is not as much of an issue as the past. Also, there could be light at the end of the tunnel. This on the left is a table from Morgan Stanley, showing that there's a lot of other supply sources besides Eskom at this stage, and it's going to be growing. So the supply shortfall over the next couple of years may actually be sorted out as these other sources of supply, particularly renewables, but also industrial private supply and small scale take up a greater load, and we can possibly navigate through this electricity crisis over the next 3 years without too much disruption. I think we are seeing political improvements. I think Ramaphosa, there were some fears he may resign, but I think he's actually got a strong mandate to lead as head of the ANC. There really is no one else besides him with really the gravitas to lead. I think that's very positive. It's political stability, which is what we need. Also gives him a much stronger mandate. I'm ready to go into the second term of his presidency and start driving the reforms he started with a bit more force, and possibly improve the cabinet. We've also seen certain arrests of officials for state capture. That is positive, and it's just a change in attitude from the ANC. I think fuel prices are falling, and wheat and maize prices seem to have peaked. So that's another positive. We may be reaching the end of the SA rate hiking cycle, possibly another 0.5%, or possibly the SARB decides to pause, but we're approaching close to the end of this rate hiking cycle. I think South African valuations are attractive relative to other emerging markets and developed markets. I think what gives us some positivity is that despite the challenges, if you look globally, there were massive downgrades in earnings forecast for particularly Europe, China, and also the US to a less extent. South Africa's economic growth will probably come out at about 2%, and really is unchanged or even slightly higher over the year. And that really just shows how resilient the economy is. I think the stock market is already priced for bad outcome, and South Africa could possibly surprise on that. I think other factors is really China opening up is very positive for South Africa. It's our biggest export market, and another positive factor. Just our asset allocation is really guided by the interest rate cycle. And what we found historically is that during tight phases, the South African stock market underperforms. And during the loose phase, where interest rates decline 1.5% off the peak, the South African stock market performs strongly. And this indicator says we should remain underweight SA equities. We just are very cognizant that maybe the rules of the game have changed somewhat, as the South African index is very China focused, and maybe the effectiveness of this indicator is undermined as a result. So investment strategy, so really pertaining to the risks overseas of a bear market in the US, we defensively positioned at 10% below benchmark. I think we wouldn't like to be much more below this because the outlook for South Africa is not that bad, and valuations remain relatively good. So we're looking at being about 10% below benchmark. Also, reason why we are below is we think the spread between equity returns and fixed interest is relatively low. So on a fixed interest portfolio, a mix of 12-month negotiable certificates of deposit and bonds, you can get yields of about 9.5%. And that's not a bad place to park cash relative to expected equity returns of, say, 13%. We're going to maintain some offshore cash. This has really been a hedge during times of turmoil. So what we find is when risk aversion increases, the rand weaknesses, and offshore cash is a great hedge and really preserves capital. It also gives us liquidity to buy into opportunities globally. We've increased our focus on fixed interest. We marginally overweight bonds. We've invested in 12-month deposits and reduced the cash drag. We think we can increase the contribution here on a long-term basis by about 0.5% per annum. We're investing in quality stocks with good payoffs. So over the last year, we have bought Truworths, been topping up Aspen. We bought a UK sports betting company called Flutter, which we think has very strong growth, and other shares which I haven't mentioned here. We've gone overweight oil. We think the oil price, the oil markets are tight, and when demand increases, oil will go over $100, and we see asymmetric upside in the shares due to historic underinvestment in this industry. And we're also increasing exposure to get SA recovery plays, something like PPC, trading close to 2 Rand. We think under a good scenario could go towards 10 Rand, and we want some leverage upside in certain shares. So the current flexible fund asset allocation, this is on the 16th of January. We're 71% equity content. We have been topping up JSE equities. We're around 10% underweight relative to benchmark. On fixed income, we've got 29%. That's a weighted average yield of 8.1%. That yield is dragged down by an offshore cash of 3%, and excluding that, the fixed income component is earning closer to 9%. I think we're happy with this. This gives a nice balance between risk and return. and really can meet our investment objective of inflation plus 6%. The balance fund, the fixed income is 44%. The weighted average yield on that is 9%. And excluding the offshore cash, which is 5%, the fixed income on the balance fund would be closer to 10%. We do have 5% in international cash. We are looking to actually bring this back. If there's a weakness in the rand, we would bring some money back because we think South Africa is a good investment destination at this stage. Equities, 56%. JSE equities, we have topped up recently. We're 36%. We're about 10% underweight relative to benchmark. I think just bear in mind, during bear markets, we find sometimes exceptional payoff companies. What we found is shares which give asymmetric upside, occasionally go up 5 or 10 times. And once we buy into these, which really come to the fore in bear markets, we've delivered very strong outperformance coming out of the bear market. Just looking at some of the larger holdings, ABSA we've had for a while. It performed very well. It was up 35% last year. We still remain positive. It doesn't look overvalued. Still offers good prospective returns, and we're looking for returns of about 20% per annum. That's been disappointing last year. We thought it'd be more defensive because global pharma has been very defensive, and we always saw the COVID contribution as transient. So we were surprised of the weakness, but we actually are positive. There's a number of positive factors which should drive the share price. So it's currently on a forward P of about 8, which is very low, but it's also got multiple growth vectors, including Africa vaccines. They make heparin, which the price has moved up. That should be a good contributor. They're doing bolt-on acquisitions. They're insourcing a lot of their manufacturing capacity, particularly in anesthetics. And they do have a good bridgehead in China, which they think can grow very fast. So it really has a lot of growth vectors, which will drive a strong share price appreciation in the future. African Rainbow, we've had this for a number of years, performed strongly last year. We retain a 4% holding. Truworths is a new holding over the last year. This company really is extremely well managed with very high returns on capital and return on equity. We also like the capital allocation strategy of management. So they bought shares during weakness over the last 3 years. It's once again growing at double digits, yet trades on a P of 7. So we were quite aggressive buyers in that over the last year, and it is performing well. Offshore holdings, Excel's been a long-term holder of ours. Really, it is more of a net asset value play. And here, over the last 10 years to the end, it's grown its compound annual growth rate at 17%, outperforming the relevant index by 6% per annum. Yet it trades at a 45 discount to some of the parts. It's well placed for the future. It's got a very big cash pile. So what it's doing with this is looking to make an acquisition, but it's also buying back shares at this large discount. Dell, a bit disappointing, and we did lighten some of these shares in the last quarter. Nonetheless, it's a good PE, very high returns. It's undertaking big buybacks, and it's got very strong competitive advantages and gaining market share. So we think this one will come through in time. Stellantis, also long-term holding, very low P. We've got it on a normalized P of 3.5 times and a dividend yield of 10%. It's very cash flush, and we like its electric vehicle transition strategy. Flutter, a new one. So we sold Entain, which was a very good performer. We made almost 3 times our money on Entain, but we think Flutter, in a very, very similar industry, just far superior management and a far better position in the US. So we see online sports betting, a massive growth area in the USA. This company has a 10-year growth trajectory over the next 10 years as it matures in the US. And we think We really like this. We like the economics of the business. We like its positioning. We like the management. And we bought a 3% holding, and we can top it up further. We're looking for returns even higher than 15%, potentially 20% plus per annum in pounds. So that really concludes the presentation of how we see markets. I think we had a disappointing year. I think we've learned some lessons and made improvements. We're maintaining our conviction in our stock picking and processes. I think the business is running very smoothly. I'm very happy with the team. So very happy with Centaur as it stands. We reassessed the portfolio and executed the desired changes over the year. So, for example, just switching Entain into Flutter, amongst many other portfolio changes. We think the rising interest rate cycle in the USA increases risks materially, and the portfolios are around 10% underweight equities. At this stage, we're happy with that positioning, and we remain confident in our processes and ability to outperform. Thank you very much. That really concludes the presentation. And if there are any questions, please just send it to me.
Thank you, Roger. We've had a few questions come in during the presentation. I'll read some out now. You are saying here that fuel has been coming down. Relatively, it has, but is still at very high levels. With your view that the oil price in the medium term could go to $150, how would this impact us, as the oil price is one of the biggest drivers for our fuel prices, and our fuel price is a big contributor to our inflation?
Okay, so part of the reason the fuel price is higher than we would expect is really refining margins globally have gone up quite a lot. So that is added onto the oil price. So that is a factor. I think if oil goes to 150, it is negative. And I think the markets are quite tight. So I think the markets are partially, this rally is because oil has come down. If oil starts going up to 100, 110, it's negative. I think this is a negative factor. So one needs to bear this in mind. I think what's also important is the adjustment period. What we find is as oil goes up, it subdues the domestic demand. It's a negative, but once economies adjust to the higher prices, then it's not so negative. But it is going to be a headwind over the next 5 years, I think. Next one.
Next one. How are you accessing oil? Sasol was said to hedge out the price. Is this still the case?
So Sasol has partially hedged. Where the oil is, it's not really affecting the realized price. Where Sasol does benefit enormously is on the refining margins. That's not hedged, and those have been very high. So Sasol's benefiting from that, but those hedges will run off in the next 18 months, and we're really looking for the upside in the oil price more in the medium term, and they haven't fully hedged out the oil price. So the other areas we are accessing it is, so Sasol, we've got a 2.5% holding. Sasol does have some issues. It's still got some debt, and it's struggling to maintain production. I think there has been some institutional decay in Sasol over the last couple of years, but we are buying some offshore stock. So Repsol is a Spanish-listed oil and gas company, and it's trading currently with current prices on a free cash flow multiple of about 17%. But if oil and gas goes up, we could look at cash flow multiples of closer to 25%. And what I like about them is they both pay a consistent dividend, but also very aggressively buying back. So they're harvesting this cheapness in their share price to create returns for shareholders. And the other one we have bought into is Shell, which has massive liquid natural gas facilities, which we think is a good area in the medium term. So in total, we've got about 7.5% in the flexible fund. We think the payoff is very good in that. We see a period similar to the 70s where oil and gas was a strong outperformer.
Next question. Why would one look at a company like PPC when recessions are most likely coming this year? Does this not mean less construction and lower revenues for industrial-like companies?
I think, the assertion that there's going to be a recession in South Africa, I'm not sure. Last year, the South African economy was quite resilient. I think the industry is very, very difficult. It's very, very competitive. But, that's why it is close to 2 Rand. What we're thinking is more in the medium term, let's say on a 3-year view or 2-year view, is that the economy actually starts picking up. So we see a lot of catalysts for increased demand for cement. So SANRAL is increasing its tenders. That's a big user. This renewable infrastructure, that will be a big user, and that's quite broad-based. And then there's also they're building the Sutu Dam. That's enormous user. That could be 4% of demand. So there are a lot of catalysts. I think we do need a stronger economy to start growing. So that's quite reliant on lower interest rates. That would be an added positive. Notwithstanding that, PPC has very good cash flow because of high historic inflation, and also they have a Zimbabwean and Rwandan operations which are doing incredibly. So it's not only South Africa and the Zimbabwean operations, they are able to remit cash out of Zimbabwe. So there's a number of factors there. On a cash flow, even despite depressed margins currently, I think it's on a cash flow multiple of about 12% with upside if South Africa improves.
Thank you. Next, do you think that the SARB has to track the Fed? Should the Fed be more hawkish with your concerns on inflation?
Yeah, I think first of all, the Fed should be more hawkish because people, I read the Financial Times this morning and they said inflation down in the UK, and then you read deeper, it's like inflation's down from 10.7% to 10.2%. I mean, 10% is exceptionally high. I think the US, if unemployment's not dropping, for technical reasons, we're going to see inflation drop because we're seeing high bases of oil which roll over on a 12-month basis. So for technical reasons, it will, but the core inflation, the core pricing power of companies hasn't diminished. So we probably need stronger medicine and possibly even a recession to kill inflation. I think South Africa has to walk a fine line, so they need to protect the rand to some level, but they don't want to totally kill the economy. So that's possibly the reason why they may hike another 0.5%. But recent indicators for South Africa are slightly more on the positive side. We've seen a firm rand. We've seen the oil price coming off. I think load shedding is not positive for demand. And the most recent inflation print was slightly positive. But they may have to move in lockstep with the Fed. Next question.
What were the outflows over the last 12 months in the flexible fund? Were they investors selling?
So we had inflows. As I mentioned on the first slide, we did have strong net flow funds. So we actually had 5% plus net flow funds across Centaur. So they were actually net buying in the flexible fund.
What's your view on global bonds?
I think it's hard to have a view. It really depends. I think I'd be cautious. I think they're going to range trade. So if you look at US bonds, 3.3%. I'm not really that positive. I think they could trade in a range 3 to 4%, possibly actually slightly higher from here. But that's a very hard call.
A Citywire report, flexible fund had a 1% position in the giant Russian bank Sberbank, which was written down to zero at the outbreak of the Ukraine war. What does this mean to investors?
That is currently about 1% of the fund, or 0.8%. So it's not written down. So it's already been, the hit has been taken last year. It really depends on how things work out. We think there could be upside if there's a positive resolution, but I think that could take a number of years. Sberbank is a very solid bank, very well managed, but Russia is, very high risk. So that's where it stands. Next question.
What is your view of a company like Air Products and Chemicals, who operates in the natural gas and hydrogen space with a high exposure to Europe, more specifically with the decreasing price of gas? Do you believe the price of natural gas will rise and remain higher for longer in Europe?
I think, just answering that, I'm not really qualified to talk about Air Products, as I don't know it very well. I think the price of natural gas is at a higher level than it was. I think it will maintain this higher range. So it's at 5.7 times over the 3 years. I think it's going to remain in this highest range. We don't have exact predictions on the price. So I don't expect it to race up massively, but I don't expect it to come down massively. It's going to kind of maybe, I'm just thinking of the graph, maybe between 4 and 8 times where it was 3 years ago.
What is your view on Renergen? Is this and the large helium deposit in the Free State? Is this a project you believe will be up and running? And is this a company on your radar?
Renergen, I don't really understand the helium market. I mean, it's quite a problematic element. So for a fact, it's got the lowest melting point or boiling point of any, which is almost absolute zero. So I think there are problems. I'm not really exactly sure what the uses are for helium. So I'm really not qualified, but it sounds, logistically very difficult to exploit this. That's all I can say.
What is your take on SA real estate and global real estate?
Global real estate, it's hard to have it as an asset class. I would be quite cautious, particularly like USA, where we're seeing reductions in demand. I think the market has been strong in the USA. I think the risks are all to the downside. I think real estate is quite a kind of risky asset class. There's big declines in demand and it never comes back. I think in South Africa it's changing somewhat. So particularly retail real estate, we've seen a strong resumption in trade in malls, particularly the high quality malls like the V&A waterfront. So I think there could be a gap in that. Industrial in South Africa is still quite tight. I think offices, there's going to be oversupply for a long time. So there could be an opportunity really in South African retail real estate. What we've seen is the clothing retailers and the food retailers actually taking up some of the spare space, particularly in the quality malls, and footfalls are actually close to record levels. So those do look like there is potential. I think we need a strong economy for them ready to start working. So hopefully I've answered that.
You noted that Europe likely adjusted to energy shock and likely stabilized. How would you reflect this in your current portfolio positioning?
It's hard to adjust so quickly. It has adjusted, but I don't know. I don't really think the outlook for Europe is that exciting. It's historically been a very slow grower. So I really will buy shares on a case-by-case basis and really looking for segments or niches which are growing very fast and have favorable attributes. So, Repsol's a European gas company. It's benefiting from exceptionally high refining margins, which we think are going to remain high. Buybacks, certain elements, flutters a global sports betting giant, which really its growth is in the US, but it's listed in the UK. So we really do it on a case-by-case basis.
What are 3 likely key surprises for SA investors that you're expecting in 2023?
Sure. I mean, that's that's a very hard one. I think a surprise is South Africa may start. What I've seen is the Zuma era really hurt the South African economy and confidence, and it's been a massive shock and taken a long time to purge that. What I'm feeling is that's starting to get purged from the system, and people are moving on from that. So we may actually see upward surprises in growth expectations. It is as we say, Eskom, we're starting to navigate away from it and possibly, so I think that could be a surprise. We may see a little bit more reform, so changes in the cabinet. We could see more extreme political changes, and if that manifests, we could actually see the rand firming. So those could be 3 surprises. I just think when that comes out, it may not be in the next year. It may be in 3 years. So that's more of a positive scenario, which may play out.
Do you think that there will be an opportunity to exit Spurbank, even if no resolution to the conflict? Is this something you would do?
Yeah, it's a relatively small holding. I'd have to investigate that. At this stage, I don't think we can exit, but it possibly is sellable because it is trading in Russia. So I'd have to check that up, and it is possibly something we can do.
Do you have any conviction on whether the MTN Telkom purchase would take place this year? If so, are you planning to take advantage of this?
So I had dinner with a friend of mine who's a fund manager, and he was actually asking about Telkom. If they do have an agreement, it's going to be an extended period of competition tribunal deliberations. So it almost definitely won't close this year, but there could be an announcement on this. I think it makes a lot of sense for both parties. And I think MTN is interested, and Telkom is in a very weak position, but does have some incredible assets. I'm not really taking a position in Telkom. I think it is speculative. The trouble with Telkom is these assets are very valuable to MTN, but without MTN, they're not that valuable. So if you think of fixed line, virtually no one uses fixed line anymore. Their mobile operation doesn't have the critical mass, so it looks quite like Cell C. So if there's no MTN deal, the outlook for Telkom is not particularly positive. So I'm not taking a position in this.
Thanks, Roger. We'll just take a couple more questions, and any other questions that come through, we'll send responses to those individuals. Your views on gold and Naspers?
So gold has moved up. I'm surprised that gold is as strong as it is. So I think it's about 1920, which is quite a high level. And it's moved up from $1,700 over the last 3 months. I would actually expect gold to move down. I would have expected with higher interest rates, gold to be relatively weak. So I'm wary of gold, but I think gold is very difficult to predict. I think Naspers, I'm surprised it's been as strong as it is. First of all, Tencent has been struggling. It seems to be ex-growth. There remain political risks, and it's not particularly cheap, nor has the cash flow been that great. So Tencent And also the other factor with Tencent is globally, when countries come out of COVID, it's actually bad for internet companies. So I'm not that positive on Tencent. And Naspers, the discount to NAV has narrowed, but I think what the company has shown is that it has destroyed quite a lot of value through corporate actions over the last couple of years. And I think the market's being a little bit too kind to Naspers. A lot of these operations don't earn, the non-Tencent operations don't earn profits. And I don't really see the route to profitability. So I remain wary of Naspers.
What probable M&A activity are you looking to capitalize on?
So in South Africa, I don't see any obvious M&A activity. Telkom is, but the trouble with buying on M&A activity, if it doesn't work out, often the share doesn't look that good. So you want to buy a positive, good share with potential M&A. We don't really see anything at this stage.
Thank you, Roger.
My view on Sibanye, I'm not positive on Sibanye. First of all, it's got a lot of legacy operations. So I've sold out 100% in Sibanye. First of all, there's massive cost increases coming through. So it's not only labor, electricity. They're very big users of electricity, fuel, chemicals. So the unit costs are increasing way in double digits, probably about 12 to 15%. And that's, last year and this year I expected another poor year of cost control. It's really beyond their control. But also I'm quite worried about palladium. So they're more geared to palladium than platinum because of their US operation. And their gold mines are very, very marginal and very difficult to close. So, for example, I think they closed the Cook shaft many years ago, probably 6 years ago. They're still pumping water, and that's costing them something like 300 million a year. So they're big legacy liabilities, even if you close the mines. And I'd be very wary of Sibanye. And with the decline in the PGM basket and rising costs, I just saw a report yesterday that it's on a P of about 6. I don't think that's cheap for really a business with a lot of fundamental difficulties. It's these deep level mines which you can't close, a lot of labor. So I'm not positive on Sibanye.
There's a couple more questions that have come through.
Okay, let's kind of maybe another 2 more questions and let's wrap it up.
Okay, the effect of fewer investable companies on the JSE due to delistings?
I think that is an issue. So one has to focus more on the bigger companies. Liquidity is an issue. So it's really reduced the breadth and maybe the dynamicism of the market. I think it also speaks to a very sluggish economy for a decade. So it does make it more difficult to invest and possibly does pay returns on the JSE. I think having said that, the South African unit holder can take up to 45% offshore. So one has to cast one's net wide and really look globally at companies. Because there are some exciting companies on a global basis. So that's one way of really getting it around. You have to be more of a global investor, not just a JSE investor. Anything else?
Given the global business cycle, what asset classes do you predict to perform the best over the next 3 years?
So I suppose, with the shortage, commodities are relatively going to be more resilient because the shortages there. I think oil and gas. And, South Africa, we're looking at very high fixed interest returns. So that's a nice place to park cash in South Africa. Then select equities can give high returns, but I think you have to choose your shares quite wisely. I am wary of the US market. It went through an incredible period. Profits are very elevated there. Valuations are elevated. And really a lot of the earnings were overstated because of share-based payments, the way they treated it. So I'd be wary on the US as an investment destination, and be very careful about what you hold there. I hope that answers that question.
Thank you. That's it for questions.
Well, thank you very much for joining me. Hopefully, it's given you some clarity on our direction, and that concludes the presentation.